All right, let's see if I can explain this in a little tough part of an environment here. Try to break this out so you guys can see what I see. All right, so basically, what we're doing is going to make a light prediction of what we're doing, and it's just a little test video as well to the screen recording process. I don't like how small that is, but anyway, right here on September the 6th, this was the market's area right here where the market had a instability about what was going to happen with the interest rates. The euro had just declared themselves in a high inflationary period. And the U.S. also was facing a high inflationary period. And the U.S. inflationary period, people were looking at more of a higher jump or a higher piece, because at this time, the interest rates were 0.5, right? And the euro, people were also measuring that, and they're saying, hey, is the euro going to equal it? Because basically what happens within this time period is the one with the highest interest rates is going to be the one that people are going to flock to, because that is going to be considered the safe currency of that time period. And so right here on September the 6th, you see that instability. But the euro was the first one to announce that they were going to be very aggressive for the inflationary period. And you can see right here that they went ahead and made a high of the next 6 trading days, showing that the euro may have a strengthening against the dollar, right? And so they were trying to price in that strengthening based on the current inflationary rate. But at the same time period, right here on September the 12th, what happened was the Federal Reserve announced theirs, that they were going to be hawkish as possible, and they were willing to do whatever it takes in order to bring the inflationary period down. So what happened was you had a severe sell-off, and that severe sell-off almost retraced more than 50% of the prior move. So what we did was we drew Fibonacci lines around this time period, and we'll blow it up. Around this time period, starting here on September the 6th, we made the new low, and September the 12th, we made the new high. And so during that time period, we could see right here, when it came to the low and the high, if you was to measure this using Fibonacci and you going up, you can see that the red retracement here on the 13th, where it should be, move it over here, the inflationary period that is showing here, the pullback was right at a 78% move, right? And so there's only 21% left out of this whole move before it can retrace back to the piece. And you can see here that the euro then bounced again for the next 4 days to say, hey, it done sold off enough that this low of 98.63, that's going to be it. But since we drew Fibonacci lines around that time period, we can draw it in here, and we can see that the 161 line for the Fibonacci retracement was showing 96.57. And so when we look at that, that's over 400 and something pips. And so we, knowing that the Federal Reserve was going to be as hawkish as possible, because the U.S. economy was not showing signs of slowing, right? And so the Fed said, hey, we're going to keep increasing interest rates until we get that showing. And when we get that slowing factor, then we'll ease up. Here, we are showing a very high increase. And since we're showing that very high increase, what ended up happening was the Federal Reserve announced their hawkish decision right here, September the 20th. And then we had 6 straight sell-off days. So the 400 and something pips, what we're looking at then is what could have been our pip value when we noticed it right here on September the 12th. And it's based on how much money are we pursuing, or how much money are we looking to gain. If you had a smaller account at $200 according to the U.S. standard, which is 50 to 1. That's the highest trading rate that we can get in the U.S. is 50 to 1. And so using that time period, using that money period, at 50 to 1, $200 would allow us to get $1 per pip. So in other words, this very heavy move from one to the other still would have only gave us $400. And if that's not enough, even though that is a pretty big return on a small account, if that's not enough for the move, if you wanted more money in the move, then you could look at using $2,000. $2,000 will give us $10 per pip, This move would have paid us $4,000, and so on and so forth. So the more money we have available to put toward the trade, the higher our return can be. And so with this move, using the Fibonacci line of a 0.9657, that gives us where our stop area is. Now, during these sell-off periods, when you measure these lines, another thing that happens is we're looking at it and we're seeing that these areas are able to go up and they're able to retract. And so during the areas of the market trying to be bullish toward the euro, and you'll hear a lot of people also being bullish toward the euro, the overall market says that we're still down, right? And so using this particular area that's showing that we're still down, what we're noticing here is we would rather stay on the Federal Reserve side because we know that they are going to be as hawkish as possible until inflation is under control. And so during this time period, even though you can take advantage of the smaller bullish runs, according to the daily chart, and make a couple of dollars on that, but the overall trend that we want to make sure that we're in is the downtrend. And so we can use these bullish momentum periods as periods of us being able to make or adding to our position, continuing the downtrend. And next time, we will take into effect a few more items that we could look at on our list, and we can go through, a couple of examples, and we'll start breaking down exactly how the pip value, how to derive it, and also we'll start it over as if we have no knowledge of Forex at all. What do we need to look at? What are the fundamentals? How does chart analysis work along with Forex? What are some dependent factors that we can use when it concerns different currency pairs? How are we looking at the Forex market in general? And that'll be future videos that we'll put together, and we'll teach everyone how to trade Forex successfully. And like always, you guys have a good day, and look